High earners are paying unnecessary estimated tax penalties because they don't understand the safe harbor rules. Estimated tax penalties can add thousands to your tax bill if you don't understand the rules. But the rules are more flexible than most people realize, especially for high earners. The basic safe harbor rule says you must pay 90% of this year's tax liability or 100% of last year's liability to avoid unnecessary penalties. But if your prior year adjusted gross income was over $150,000, the requirement jumps to 110% of last year's liability. Here's where it gets interesting. You can use these rules strategically. If last year was a high income year, but this year is lower, you may want to pay based on last year's projected liability. If last year was a low income year, but this year is higher, paying based on last year's liability may be the smarter move. There's also the annualized income installment method, a lifesaver for people with uneven income. It lets you pay estimated taxes based on your actual income each quarter instead of assuming equal quarterly income. And here's what most people miss. You can adjust your estimated payments throughout the year as your income picture becomes clearer. You are not locked into whatever you guessed in January. Avoid estimated tax penalties while optimizing cash flow. Follow me for strategic estimated tax planning.